my name is Brian Overby. I'm known as the Options Guy, and I'm the author of The Options Playbook. Okay, today on Options Guy TV, we are going to have a theme. The theme is going to be long calls. We're going to try to stick with that theme this week, but we are in the second half of earnings season, and we're going to look at a couple of earnings season trades, and long calls aren't always the best to be looking at around an earnings announcement. A lot that has to do with implied volatility. But we're going to try to keep that theme. And one of the reasons why I want to talk about long calls is that there are a couple of companies that have just announced earnings. And when that happens, I find it much more feasible to take on longer term strategies using long call options as a surrogate for the underlying stock. So big earnings week. We still have about half of the major companies that in the S&P 500 index that need to announce earnings. We had a couple of big weeks just recently. JP Morgan started off earnings. That's always kind of a kicker for me. That's usually, to me, the start of earnings. I don't know if there's an official start or a gun that goes off each quarter before companies start announcing earnings. But to me, JP Morgan is. We saw a lot of the financials announce earnings. And because of that, one of the companies that I'm going to focus on today is going to be Charles Schwab. They had a solid earnings report, and the company and the stock acted positively after that earnings report. So let me go to my options grid and let's highlight some of the stocks that are going to be announcing earnings now. So here we see the TradeHawk trading platform, and on the left-hand side of your screen, you see my watch list that I put together based off of companies that are going to be announcing earnings and that we're going to talk about on today's show. So once again, we're seeing strength in the market. Good to see the Russell actually up a little bit today, a little less than 1%. SPX just kind of hanging in there also with the NASDAQ. But the Russell has had a fairly strong move along with the SPX and the NDX. And that's always a good thing to see some of the small caps doing well and kind of helping out in this market rally that we've had. Last week, we saw the Dow Jones Industrial Average almost break a record. They were up for 13 days straight. Everybody was pulling for that 14th day, which would have been, I think, the longest. It might have been the longest number of up days in the Dow ever. So everybody was pulling for it, but it just didn't happen. But we did see a lot of strength on Friday after a few earnings reports on Friday. Okay. So VIX index came off a little bit. We had the Fed meeting last week. We see it trading at 1385. Really wasn't a ton of movement in the VIX index. We went through great detail about the SPX, and we looked at a long call spread last week versus a long call. And hence the theme last week was about long call spreads. This week, we're going to have the theme that's going to be about long calls, but we'll probably toss in an advanced strategy at the very end. We have Amazon and Apple announcing on Thursday, and I've talked about this more than once in that it's always interesting and it's very speculative. On Options Guide TV, we're going through 3 different strategies every week. And so around earnings, I like to look at specific trades, mainly because we learned so much about option pricing. And on Thursday, we have Apple and we have Amazon both announcing after the close. Fairly expensive stocks, and you have 1 day for those option contracts to live after they announce. So I always like to look at maybe a little bit more advanced trades, butterflies, something that really likes volatility crunch and time decay. So I'm definitely going to be selling some options. And unfortunately, we do Options Guide TV on Wednesday instead of Thursday. So, but we'll probably discuss, we'll have a hop over to my Twitter, which is my handle's at Brian Overby, and we'll do a little poll. What option strategy do you think will do better? I'm not going to say what stock will do better, but we'll maybe look at 2 different option strategies and have a battle. And you guys can vote to see which one you think will win. So you would hop over to at Brian Overby. It's very simple, at my name. And I'm going to put out a poll after the show today. And well, I guess I'll do the poll on Wednesday. We'll put that out on Wednesday, and we will try to see who do you think will perform better what option strategy do you think will perform better after they announce earnings on a Thursday? Okay. So PayPal's announcing, that's an interesting stock. That stock has kind of bounced off of its bottom, making a rally. Also Coinbase, they've really been strong recently, and I see that they're up 4% today. It's an exchange that trades crypto. It trades a lot of things, and they've done very well with coming up with ways to trade different products besides stocks and options like most of the major exchanges. So Coinbase usually follows crypto stock. Doesn't necessarily, that's not their main focus, is trading in general. And they run a very good exchange, very good management team. But they collapsed with the drop in crypto. They are now making a strong comeback. So I think this earnings report on Coinbase is going to be extremely interesting. Then we have Uber. Uber's going to be announcing. I always like to know what's going on in that space. And the stock that we're going to look at today is Schwab. Now, they've already announced earnings, and shortly here, we're going to look at a graph. And then lastly, we have an interesting setup, and I kind of hinted to it in last week's Option Guy show. But oil has been interesting recently, and we actually did a earnings play on ExxonMobil around earnings. The fact that they announced Friday morning before the open, and once again, we had options that would expire on 1 day's worth of trading after announcing earnings. So I find this very interesting, and this is the story of an options trader's life. But I'm going to highlight down in the corner. I put it in my little trading tower, ExxonMobil. So we did a 102, 108 long call spread. Stock didn't really do much. We set up the trade fairly good in that we were wrong and we didn't get cremated. The stock went down a little bit. It ended up pretty close to flat, actually, at the end of the day. I think it was right around 104. But we lost a dollar. I think we lost about half of our investment, which was $3 on a 6-point wide spread. But it was just a paper trade, just as always. We're just trying to learn. But now we see the stock today, it actually almost hit 108. It's now trading at 107.05. So day late, dollar short. It's up almost 3% on the day. Not quite sure. I actually, did a quick little Yahoo Finance search to try to figure out exactly why it's up. But I didn't have time to actually figure out why. But unfortunately, if we would have had a 2-day option as opposed to a 1-day option, well, the trade might have worked out. But it didn't. So let's move on. Let's look at Charles Schwab now. Okay, so here we see the options grid. We have Schwab. Right now it's down 20 cents. But I'm going to run over to the chart inside the Trade Hawk software. And here we have Charles Schwab, and I actually put together a Fibonacci, which I think is interesting, and my normal moving averages. We got the 20-day, 50-day, and the 200-day. There's a lot going on right at this level in Charles Schwab. So talk a little bit about what has happened with the moving averages. We don't have our ducks in a row. And if you go back to what date is this right here? 3/9. On 3/9 is when the major news came out about the regional banks, and we had a couple of them that were saying that they may go under, struggling with the rise in interest rates that the Fed had. Well, I should say how quickly the Fed chose to increase interest rates hurt a lot of the smaller regional banks. But Schwab wasn't really involved in that, but it did go down with it, and we had a big red candle to the downside and another big red candle. Now, we don't have our ducks in a row. Ideally, you like in the S&P 500 index right now, we have the 200-day below the 50-day, below the 20-day. Here you see we obviously had the downturn. This was what they would call a death cross because you got the 20-day and the 50-day crossing over. And once again, that's just a data point. It's not, I always like to see when it happens, but it's only one little data point in trying to figure out if you want to buy the stock or sell the stock, that type of thing. Markets came down. 50-day moving average. Right here, we have what's called a golden cross, where the 20-day crossed the 50. I think it's more, I'd like to highlight a little bit more when you're talking like a 50-day moving over a 200-day. In other words, you're taking a slower moving average over anything that happens around the 200-day moving average. I find is a very interesting point. It changes the whole dynamic of that underlying stock. Okay. So I grabbed a Fibonacci from this point, came all the way down to the low point here. And guess where the 50% retracement level is? Right here, right where all of this noise is in Charles Schwab. So here they announced earnings, strong earnings day, and we're just hanging around this 200-day moving average, wondering if we're going to break through the Fibonacci number. I mean, there's just a ton of stuff that's going on right in this range. Schwab didn't, obviously, financially, if anything, they probably benefited from the downturn. And, Schwab is a bank. They have Schwab Bank. And obviously a very big brokerage firm. They're the ones that turn the industry on their head by going to zero commissions, from $5 a trade down to zero commissions for stock. And so I'm going to get along a call here. I'm going to go out further in time, and we're going to look at a deeper in the money call option. You could wait around a little bit to see if you break out at this level. And let me see if I can can't quite grab that chart and move it over. But if we did break out a little bit and came back to around this level, right around that 8.5% retracement level on the downside, that would be a real interesting point. I really kind of like that range right there. And I guess we'll talk about maybe selling something around that. But part of the reason why I wanted to look at Schwab and buying a long call as an alternative to buying the stock is that they've already announced earnings. So a lot of that volatility, a lot of that juices came out of the market. This is when I like to look at long calls. Everybody's now focused on what's going to happen with Apple and Amazon. Nobody's looking over here at what's happened with the financials. They've already announced their earnings, and the whole industry is doing well after their earnings announcement has came up. A lot of stocks are strong in that field. Obviously, Schwab is one of them. So let's go back and look at the trade. Okay, because we're going to treat this as a more longer term trade, I'm going to go out to January, which January 19th expiration. And I'm highlighting it here on my options grid. 172 days out. We're still trading at fairly high implied volatility. It's around 30%. Back here in the front month, we're around 25%. But I would say that's pretty normal for a stock like Schwab, and a lot of companies that are in this industry. They trade right around 25% implied volatility. But it has dropped off and after the earnings announcement, and I don't mind buying this. Now, why the January expiration? Well, I wouldn't necessarily plan on holding this all the way to January, but I want that option if I'd like to. If I want to take this on as literally an investment, it would still be a short-term investment, 172 days, but I'd rather have the option to be able to push out any taxes or capital gains out to January. So I kind of like, if I'm deciding between December or January, I'm gonna go with January. It's just that simple, because then that takes it out to the next year. Okay. So here's the trade here's the theme that's behind this. We're going to buy the stock as a surrogate. We're going to buy this option contract as a surrogate for owning the stocks. So that means we want something that's going to act like the stock, and it's going to be a fairly expensive option relative to what I guess a lot of novice investors like to look at the money or the out of the money option contract. But we're going to get a lot for that option. We're going to get a large delta, and delta tells us approximately how much our option should move based on a 1-point movement in the underlying stock. So on the options grid here, I'm going to highlight delta right now, and I'm pointing at it. I know that it can be tiny on your screen a little bit, but we're going to look at the 52.50 strike, or I don't mind the 55 either, but I want something around an 80 delta. And I'm going to concentrate on intrinsic and extrinsic value. Extrinsic value is basically time value, because here's the downside of buying this option is that we're deep in the money. We're going to get some real value here. We're buying something that has a lot of intrinsic value. You can't take that away from us, right? It's $13.25. That is what we get if we exercised our option and sold it on the market instantly. That's what it's intrinsically worth. That means we have about $2.10 worth of time value, of extrinsic value. And so I'd like to try to wither I like to keep that in mind, how much time value I bought when I put on this trade, because I might sell some calls against this position, almost like a covered call would be on an underlying stock. So I want to look at that extrinsic value, make note of how much time premium I'm paying, because that's the benefit, or that's the detriment that I get when I buy an option as opposed to buying the stock. I got to deal with that time value. I got a lot of intrinsic value. I get what I'm paying for, but I still got a little bit of extrinsic value that I got to deal with. Delta's 82 right here. Let's call it 83. Let's round up. That means that if the stock goes up 1, our option contract should go up by about 83 cents. And here's the most wonderful thing is that if you go further and further in the money, we pick up delta. In other words, let's go deeper in the money on the option chain down to the 45 strike. And you see now that delta is at 90. So for example, if this stock moved up, this option contract would become more in the money and it would start acting more and more like the stock. Now here's another benefit of that option, in that if the market goes down, guess what happens to the delta, right? So if the market goes down, it would act a little bit more. This option contract will be looking like these option contracts, because it's going to be further and further out of the money, and the delta starts decreasing in stock. So when I do this, it's interesting in that if I'm correct on my forecast, you can almost say I pick up more shares of stock because it's going to act more and more like the stock. If it comes down, I lose less and less as it comes down. As a matter of fact, I always like, if I'm going to do a long in the money call as a surrogate for the stock, I always like to set an alert right at that strike price. Because let's say if we put this trade on today and we're looking at Schwab at 65, we're highlighting it in the yellow here, and the market came all the way down to the 52.50 level where we see that 82 delta, guess what? That option should be trading about where the at the money option is at right now. This would become an at the money option, and you're looking at getting out or being able to sell it at this point in time, right? We're saying at this moment, because we're taking a snapshot of the chains, right around $6.45. Okay, so that's my out point. This isn't the stock. I'm not going to hold it forever. If it came down to my strike, I want to take advantage of the fact that a lot of time premium settles right around that strike price. So if that does happen and it gets to that level, I'm just going to get out. I don't care if it happens on day 30, on day 50. We have a day 170, right? Because we have 172 days. Going to highlight that. This is our expiration that we're looking at, 172 days. That's my out point. I want to take advantage of as much time premium. Now, obviously, if it happens on day 100, the at the money option is not going to be trading for as much. There's just not as much time premium in it. But you're still going to get some juice. You're still going to get the benefit of that volatility, that at the money option contract and all that time premium being in it. Okay. So that's our plan. Our plan is that we're going to put this on. We got to decide where we would want to get out at. And then second of all, we got to decide where we want to stop at. So my stop, it's just that simple. I'm going to do an 80 delta. It comes down to that level, I'm going to be out. Now, on the upside, I kind of like to look at it as a doubler. I'd really like this to be trading somewhere around $30. And if we look at the chart, there's room for it to run. But I'm going to be a little bit not as assertive on the upside, because we're looking at a longer term option. Obviously, if I double, I'm going to get out. That's a no-brainer to me when I'm trading options and a long call option like this. If I get a doubler, I'm going to want to get out on this this investment, I should say. If not, though, I want to really kind of look at the chart and let the chart kind of determine, look at the market, look at what's going on, and just determine where I want to be. But one of the biggest things that I see on this chart here is, first of all, not that long ago, Schwab was trading up around 96. This is obviously an interesting point where I grabbed my Fibonacci to start with, which is right around 85. Well, 86.48 is where that is at. So if we do get this little breakout here, here's a gap. This candle got filled. Here's another gap. So right around in this range, maybe I for sure would want to sell, maybe look at selling a call at that point in time. But then we go all the way up to the 86 level. So it's an interesting stock, interesting way to do it. We still have some risk in the marketplace because obviously people still talk about recession, but now they definitely say we're in a soft landing. Fed might still come out. We got September and October coming, and that's always scary months. We have a Fed meeting in September. That's going to be a focal point of September. But those are usually the more volatile months, and a lot of times, I think September might be one of the only months that, in aggregate, is usually a down month, just a smidgen. But over the last 15 years or so, usually September is a down month overall for the markets. All right. So I see, well, actually, I see we got a comment here. So I do got a question. I'm going to put it up on the screen. Okay. Would you ever sell a call against your long position at the beginning of the position? Actually, that's a great question. And I would consider it on Schwab. And I guess I'll focus on this chart here, mainly because we haven't really broken out yet, right? There's just a lot of noise that's going on. And if I did, I would do it very short term. I mean, I would talk about like 15 days. So let's go back. First of all, let's make this an official paper trade. But usually when I'm buying an option contract or I'm buying a stock, very rarely do I sell a call on it instantly. And it's mainly because when I'm buying it, I'm buying it because I think it's going to go up. So why do I want to sell a call right away? A little bit nervous about the chart, and we haven't had the breakout. If we had the breakout, I'd rather just own the stock. Or I'm sorry, the option. I don't want to cap my upside, but it's feasible. It's feasible based off of what we're seeing on the chart. So I don't mind it, and it's a great question. I really appreciate that question. So the official paper trade is we're going to look at buying this 80 delta option contract, the 5250 strike call. It's trading, and this is another big thing about long-term options, and Schwab has decent liquidity. We're 1545 on the ask by 1530. It's still a lot wider than the stock, but it's not too bad. So when we started it, the midpoint was 1525. I'm going to click on it. Let's go 1540. And since it's ran up a little bit on us, and that's going to be our official paper trade for this week. And we'll come back and we'll look at this trade and we'll discuss what, especially if I see some things on the chart, like maybe selling a call at a later date, and we'll try to keep this position in mind. But right now I don't want to sell a call against it. But if I did, I would be looking at a shorter term call. So let me click on a different expiration here, maybe 11 days out. And I want to target a chart. I want to target this range right around here where this gap gets filled. So I'd want to sell something around the 74 level, 73 level, but it obviously depends on the premium. Yeah, we're not getting anything on that. So we'd have to go out to 18 days. Let me look at that. So no, I don't really want to sell it. I really don't, mainly because there's just not enough premium at the levels that I would be considering that the stock may bounce off of. So if we do get the breakout, the only one that's probably worth selling, and I'll take a little less premium in. I don't mind that because we are paying a lot less for the stock. On a covered call situation, I'm usually looking to bring in somewhere close to $1 or $2 on a $65 stock. Here we're going to go out. If we even look at that 18-day option contract, the 69 strike is 41 by 38. Maybe 40 cents I get. That's okay. That would be the one I would look at if I was going to sell one on the short term. But I really don't want to do that with this position. All right. So any other further questions that you might have on the Schwab trade? If not, I'm going, and this is an interactive show, so please put your comments in. I would love to try to involve as many people as we can in Options Guy TV. It's a great benefit to be able to do that, and to be able to answer your questions live. So we're going to move on from this trade. I'm getting a little bit long-winded, and I want to just look at a setup on a new trade. And I don't want to look at doing it right now, but it's going to be kind of some follow through that we had from last week's conversation about oil in the USO. But in order to do that, I'm going to have to switch screens, mainly because I need to look at a chart in oil, and we don't have access to those charts. All right. And also, here's a bonus. Here's a bonus. Let me zoom in on this a little bit. Here. Okay, so now I'm ready to share my charts, but I'm going to start by looking at the fig leaf, which is actually the name of the strategy if you sell a call against it. I came up with it inside the options playbook, and it's kind of taken off, and you can actually read a little bit about it down here at the bottom. This is actually the options playbook website about the name and how we decided on that name. And here's the thing is that this is one of the most popular option strategies out there, surrogate for a covered call, and it never was named. So we had names like leverage covered call, which that kind of makes sense. I've heard surrogate for a covered call. I've heard leaps diagonal, which is technically right because you're buying a longer term option, selling a shorter term option against it. So you're going diagonally on the chart. But if you want to learn about that strategy overall, you can go to optionsplaybook.com and check out the fig leaf. Okay, now I'm running out of time. So I want to show you the chart. This is what I was talking a little bit about last week. I kind of hinted towards it. Here is crude oil. Here is the mercantile exchange chart on crude oil, the nearest term contract. We see that today it's up 1%, which is a solid move. But the big thing to me is that it broke up above the 80 level. This 80 level in oil is just, you see there's a lot of noise around that 80 level. Even if you go all the way back to years and years and years and years, $80 a barrel is, if it breaks through to the upside, sometimes you can see some strength here, but it always seems to be battling around that level. What I'm highlighting today is the 200-day moving average. So this is a couple of years out. I clicked on a 1-year chart, but then I zoomed out a little bit so I can show you some of the highs in the barrel oil future. And we see that on the 200-day moving average, we bounced off of it right around that 80 level. But guess what? We finally had a breakout in it right now. And some of the strength today, if we break through this high area right here, this becomes an interesting trade in general, just from the chart, and also what's going on in the world and everything that we have, geopolitical situations and potential for recession. They're still saying that it's not off the table. September and October are coming. The Fed's going to have a meeting in September. Just a lot of interesting things in that level. So I don't trade oil. I don't trade futures. A lot of times because a lot of the firms that I've worked for that don't offer the futures trading. So the one way that I'd like to trade it is to look at the USO, and the USO has really tight markets. So if I look at this, we see our ducks are coming in a row here on USO. We highlighted last week that we had a breakthrough on the 200-day moving average and fail, another breakthrough and fail. And we were right here when we were talking about it last week. So I even mentioned on the show that this is a real interesting area right about this, where this new high is. So a lot of times when you get a breakthrough and fail, it's really hard for that 200-day moving average to keep pushing that stock down time and time again. And usually third time's a charm. And this time we had the breakout, and we did. It was a solid breakout. Even if you just traded it from here to this high, it was a solid breakout. Our ducks are getting in a row, right? We got the 20-day crossing over the 200-day, which is a good thing. We had the 20-day cross over the 50-day, which is a good thing. So things are looking a little rosy in the USO. So if I was going to trade this, I'm going to, like I said, this week our theme is long calls. I would look at a more speculative type call on a shorter term basis. We're going to wait for this setup, see if we get a little bit of a breakout here. And maybe on Wednesday, if things are still staying rosy in oil, we'll look at a long speculative call in the USO. Once again, none of this is meant to be recommendations. we're going to talk. The main reason why I want to talk about a speculative call is because we looked at one that was a little bit more on the investing side of things. All right. So we are right at time. But if you have any other questions, I see another one might have popped up here. Yes, I do have a question. Let me put it up for you. Under what conditions would you consider exiting the long call before January? All right. Well, see, when I'm doing it more as a surrogate for the stock, I'm going to let the chart kind of tell me a little bit more. But I'd still realize that even though this is a longer term trade, and I consider this literally more of an investment than a speculation when I'm going out 172 days and I'm trading it because I kind of like the industry at this moment. It's a little bit different than just speculating on the USO. And that's why I want to have two different companies. And I searched for two different companies, that one that I might buy a deep in the money one and one that I might buy an at the money or out of the money option on. And so under what conditions would I sell that? Well, if it doubled, I would sell. And that would be the first condition. Second condition would be, well, let's see what's going on in the chart. And obviously the Fed. One thing that I really want to see in the financials, and even as a longer term play, is eventually the skew or the difference between the 2-year and the 10-year has to come back more in line. And if that does, that's going to be extremely good for the financials. And you want to be in financials before that happens. So the Fed's still looking to raise interest rates, but the stocks had just strong markets overall. And that's part of the reason why I'd rather buy an in the money calls, because there's still a lot of risks up here. The difference between the 10-year and the 2-year interest rate is still, fairly substantial. And that hurts financials. That hurts banks in general. So those are the things I guess that I would look at. I don't know if I actually answered that question, but I if I double, I'm out, look at the chart, I kind of see some support or some resistance, well, then I might consider getting out too. But in my mind, I don't necessarily have a goal on the upside, but I do on the downside. It comes down to the strike price and Schwab. We're going to get out of that, and that's going to be our paper trade for the week. Thank you for your questions. Want to make this as interactive a show as possible. Please click subscribe, pound that thumbs up. I'd really appreciate it. And ring the bell. Make sure you get all of the alerts for Options Guide TV. Thanks for coming, everyone. And we'll see you this Wednesday for the next episode of Options Guide TV.